Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Today, we discuss the current state of US tariffs. There is so much that has been going on ever since Donald Trump came to the Oval Office, and the kinds of announcements and backtracking that he has been doing. It is very difficult to keep track of what actually the current situation is. The tariffs started with a 25% tariffs on steel and aluminum imports into US. After that, a 25% tariff was levied on auto and auto components. Again, those were imported into the US. On 2nd of April, on his Liberation Day address, a flat base rate of 10% on all the imports that happened to the US was levied. Now, apart from this, what he did was he also announced country-wise tariffs. How these tariff rates were calculated? Well, the rates were different for each country. Now, how those tariff rates were calculated, to explain it to you in very simple terms, say suppose India is exporting goods worth $100 to the US, and US on its part is exporting, say, goods worth $40 to India. So what happens is we are actually going to get $100, where we'll have to pay only $40 for US imports into the country. So we in India are in a trade surplus. USA is in a trade deficit worth $60. Correct? So what Donald Trump did is he calculated that trade deficit, divided it by the total imports from a particular country into US. So $60 was trade deficit with India divided by the total exports that India did to the USA, which were $100. So that figure came to 60%. But what he said is he was being lenient and was doing a favor to countries. So he slashed 60% into half and charged 30%. Correct? This is how tariffs were calculated for individual countries. Now we in India faced 26% tariffs. But in a shocking announcement day before yesterday, what Donald Trump did was he paused all those tariffs for a period of 90 days. What happened suddenly that where he was saying that more than 75 countries were lining up for trade talks with him to reduce the impact of tariffs, and what suddenly happened that made him change his mind? Let us look into that. Currently, the 25% tariff on steel, aluminium, auto sector, and the flat 10% base tariffs are in place. So, those tariffs are still chargeable. So, the 90-day pause is for individual country tariffs, but barring one country, which is that China. US President Trump, in his address, where he said that he would pause the tariff for 90 days, he excluded China and, in fact, increased tariffs on China. US imposed a massive 125% tariff on Chinese goods. Now add the 20% that it had levied on fentanyl, bringing the combined tariff levy to a whooping 145%. Now, China, on its part, retaliated by imposing its own 125% tariffs on American products, up from 84. Now, this 125% tariff is effective from April 12th, 2025. It is very interesting to understand what really triggered Donald Trump to backtrack on his tariff decision. Now, on 2nd of April, when Trump had announced reciprocal tariffs, S&P 500 index had fallen nearly 15% till April 7th. But Trump was firm on his policy. During that period, between 4th April and 8th April, the US bond yields rose sharply from 3.8% to 4.12%, signaling a trouble in the bond market. What is interesting to understand is what triggered Trump's tariff pause. Now, on the 2nd of April, when Trump had announced reciprocal tariff, the S&P 500 index fell nearly 12% from April 2nd to April 7th. Now, what happened in the bond market? In the bond yields spiked from 3.8 to 4.12 from April 4th to April 8th. Now, this increase in the bond yield is what has triggered Trump to announce a pause on his tariff policy. Now, why did the bond yields rise? What is the relationship between the bond prices and the bond yields? Here are some basics. Bond yields are inversely related to the bond prices. So, when the bond prices go up, yields go down, and vice versa. Take, for example, a bond is priced at $100, 4% interest. So, the yield will be 4%. But say, suppose the price of that bond fell to $90 from $100. At 4% interest, what will be the yield? The yield will be 4.4. So the yield has gone up. That is what happened in the US bond market. Initially, the bond yields fell from April 2nd to April 7th. Now, when the stock market was crashing, investors fled to safer US bonds, raising demand for bonds, thereby increasing prices, and the yields fell to 3.8. There was a sudden spike on April 7th and April 8th. On April 8th, the US government tried selling 58 billion in 3-year bonds. But the demand was weak, which is very unusual. Why? Because the US government bonds are said to be the safest investment option worldwide. US banks had to buy nearly 20.7% of the unsold bonds, the highest since December 2023. Hedge funds normally use levered bets on bond futures versus cash prices. Now, as the stock market crashed from April 2nd to April 7th, funds faced margin calls and sold bonds to cover losses, thereby crashing prices and yields spiked. Experts are also speculating that China, Japan, UK reduced bond purchases to protest against tariff, fearing inflation from higher import costs. Thereby, the demand for US Treasury bonds fell and the yields rose. What was the impact of rising bond yields? Well, corporate debt also faced crisis. Now, corporate bond yields, which are priced normally above government bonds, also surged. In the sense, prices of corporate bonds fell and their yields surged, freezing corporate borrowings. Banking sector and insurers holding bonds faced losses. A similar situation like the Silicon Valley Bank crisis in 2023 would have arisen with many banks across the US, risking liquidity shortfalls. Inflation fears were in place. Well, rising import cost, rising yields, all this could spike inflation, forcing aggressive Fed rate hikes instead of Fed Reserve easing, which was expected by Donald Trump. What would have been the global implications, especially for India? Well, India holds nearly $675 billion in forex reserves, mostly in US government bonds. Any crash in the bond market would have eroded the reserve value. Now, India relies on dollar reserves to import goods, even from Europe and China. A weaker dollar demand could disrupt trade. The auction failure sparked debates about declining faith in the US dollar as a reserve currency. However, the global dollar dependency is impact as of now. What are the key takeaways from all this for investors? Well, bond markets can override political decisions, as was seen with Donald Trump's U turn. Monitoring US Treasury auctions and hedge fund leverage trends, which show early signs of risks. Then, diversifying the portfolio to hedge against bond market volatility and dollar instability is always advisable. This was part one of this video series where we tried to explain what caused the pause. But more important part is yet to come. In the second part, which we will release tomorrow, we will explain the impact of the trade war between between US and China. Now, combined, the two of them represent nearly 43% of the global economy. Any slowdown in both these economic giants will have a ripple effect on the rest of the world economies. So, what does this escalation of trade war mean for US, the China, and India in particular? That would be the second part of this video. Check out for that video, which will be released tomorrow. Until next time, stay safe and goodbye. Before we go, do not forget to like, share, and subscribe to our channel for more such informative content. It will be very helpful in our endeavor to reach maximum number of people and help them understand finances and investments. Thank you.